Welcome. So this is, I think, a really interesting topic, and I think we've got some great people who know way more about it than I do, and I've learned a lot just from the rehearsals. So I think you're going to find this interesting. I'm going to have people introduce themselves. Why don't we begin with Susan, and then Adam, and then Chris, and just say a few words about who you are and your connection to the topic, if you'd be willing.
Sure. Terrific. Thank you very much, Phil, and it's wonderful to be here today. My name is Susan Laidlaw. I'm a vice president at Fidelity Charitable in the private donor group, and I work in two different capacities at Fidelity Charitable. I work directly with donors, primarily located on the West Coast. And I also work with philanthropic partners of Fidelity Charitable and grant-making organizations to participate in growing the sector of charitable giving. My relationship to this topic is back when I worked at Duke University at the business school, I was a fundraiser, and one of the organizations I was a fundraiser for was the Center for the Advancement of Social Entrepreneurship, as well as Case I3, which is an impact investing initiative at Fuqua. And when I came to Fidelity Charitable in 2015, I was very excited to learn that Fidelity Charitable was embracing impact investing as a way to approach both grant making and investing through the Donor Advised Fund. And so I work with my donors who have an interest in doing that.
Thank you very much. And Adam?
Thanks, Phil, and great to be here. Adam Rein, a co-founder at CapShift. CapShift is a venture that was formed 4 years ago to bring impact investing and catalytic philanthropy solutions to leading charitable institutions. The main thrust of our focus is on working with large donor advised fund providers and other charitable institutions to help them offer more options to their donors to meet their purpose through impact investments and recoverable grants. We work with great partners like Susan and Fidelity, and for recoverable grants specifically, we're excited to be here as we believe we've supported more recoverable grants over the past year or two than any other platform.
Fantastic. Thanks, Adam. And Chris?
Hey, Phil, good to see you again.
Hi.
Chris Blunt, I'm CEO of Fidelity and Guarantee Life. Prior to that, I was CEO of Insurance Solutions at Blackstone, and before that, spent 13 years at New York Life in a number of leadership roles. I think the reason I'm here, though, is before that, I was CEO of a company called Giving Capital, which private labeled donor advised funds into the financial advisory community. So it's always been a passion of mine. I'm a CAP, I'm a trustee of the American College, and for full disclosure, an angel investor in CapShift. So happy to be here.
He's also a very significant donor to the American College. I would like to thank him for that as well. So let's start with the most basic question, because I really did not know what recoverable grants were when we started. It sounded like a very promising topic, but maybe we could just have Susan tell us a little bit, what exactly is a recoverable grant, and why isn't it illegal to get your money back?
Sure. Well, the easiest way to describe what is a recoverable grant is to think about what it is not. It is not a loan, although many people do put it in that context because it is easier to think of that way. But in the most simple terms, a recoverable grant is a grant that is made to a nonprofit organization that is based on agreed upon terms between the donor and that organization. And the difference between it and a grant, straightforward grant, is that the nonprofit may repay the grant proceeds back to the donor. So that's what the structure is. The opportunity itself is a way for donors to basically recycle philanthropic capital, putting it to use with an organization, and then having the possibility of receiving that principal back into their account.
Mm-hmm. And I think you were telling me before that if they don't repay it, then it actually becomes a pure grant, and it's typically done with donor advised funds. Is that correct?
Yes, that is correct. From a donor advised fund perspective, the accounting of it, if you will, since it is a grant, it is basically a grant that if the proceeds come back, it goes back into the donor's account. Without getting too much into specific examples, there are situations where the grantee may pay a certain rate of return on the principal amount of the grant. And as those proceeds come back periodically during the refundable grant term, those assets are booked as a return of principal. So it is possible to sometimes get more than you granted out. But to the extent that the monies do not come back, you basically are just committing to either rolling the grant over for another term or just basically saying, my grant term is over for the recoverable period, and I'm happy funding the organization as a normal grant.
Thank you very much. That's very helpful. And Adam, what are some specific areas where you've seen these recoverable grants used successfully to achieve impact?
Yeah, recoverable grants have been around for decades, but have been used relatively sporadically. And it's really over the past 5 or 10 years that the tools become more popularized. And I think it's come hand in hand with some other trends in philanthropy, which is, how can I be more catalytic with my philanthropy? How can every dollar have more impact? How can we help nonprofits be more financially sustainable over time? And that's where recoverable grants tend to align with those goals. So one big purpose we've seen is around bridge financing, which is a nonprofit, and you saw this a lot when COVID hit, who their fundraising or revenue streams are disrupted, and they need to try to only raise a larger amount of grants temporarily, and they may not even need that funding long term. And this may be a tool to help get those nonprofits funding quickly. I think a second common use case we would see would be scaling a new program quickly. So let's say we want to do our first international program, but fundraising takes a long time. We need those bigger checks more quickly. Offering the chance for the donors to recover that capital may help those donors stretch more deeply into the corpus of their charitable account. And the third one would be what we'd call big bets, which is we want to fund things that might not work, but if they do, they might offer a large financial return for the nonprofit. And to help fund those larger programs more easily, offering the donors a chance to recover capital in line with the return of the nonprofit can help them write bigger checks.
Are these normally structured as debt or as a loan where there's going to be a return, but it's not an equity? There's not an equity.
Yeah, I think as Susan highlighted, the key thing, and the name says it all, is that recoverable grants always are structured as grants. So this is a grant agreement.
But is it equity-like? Are they sometimes equity-like, or are they almost always debt-like?
Yeah, and I think I would separate out two things. One is, what does the agreement look like? The agreement, I would think, is a more like a complex grant agreement. Like if you're endowing a professorship at a university, it may be more than just a simple grant agreement. It's complex in terms of what in that side letter are you including along with the grant. And recoverable grants happen to have a provision that may allow what might a recovery of that grant look like. But what it is not is an investment security.
No, that's good. I mean, that's really like a compliance point, right? You're making us aware that you have to describe these carefully.
Yeah, and I think the main thing that goes hand in hand with that is that, unlike an investment security, there is no securities regulation or right of the donor to kind of pursue legal avenues to kind of recover the grant. Really, this is based on kind of expectations and trust in the recipient nonprofit to recover those grant proceeds. But only if the grant achieves its success metrics. And so this is allowing that donor to take the risk and saying, if what we're trying to do doesn't work, we're not going to recover anything. But if it does, and that nonprofit recovers proceeds, then they're going to share a portion of that back into the donor's account. Right.
Well, this is very interesting. There are a couple of questions that have come in. They're really clarifying questions. So let me just ask them. One person is asking, is this a form of microfinance? How would you compare this to microfinance? Does it come specifically only from donor advised funds? So it looks a little bit like microfinance in the sense that you're recycling capital. Is that, how would you distinguish it from
maybe I'll take that. Microfinance or micro lending is different in a couple ways. One is that most microfinance happens focused on emerging markets or a specific use case, which is hey, how can we give loans to very low income recipients through intermediaries? That checks are very small, $100, $1,000 at a time. And it's really geared towards providing that loan to kind of an underlying family or small business. Much of that is through investment securities as well. So I think recoverable grants have an overlap, which is many of them, you know, funds are going out for charitable intent and then dollars are coming back. But these tend to be not driven to supporting individual families, but supporting broad nonprofit.
No, that's very
programs.
helpful. That's very helpful.
Yeah.
And just to be clear for me too, and the people are asking it as well, who can make a recoverable grant? You've got individuals who are taxable, you've got donor advised funds, and you've got foundations. Can all three or just donor advised funds typically make recoverable grants?
A recoverable grant is really between the donor and the organization who is receiving the grant funds. So, and a donor advised fund is basically the vehicle through which, you know, some donors fund their philanthropy that way, but certainly private foundations can enter into recoverable grants directly with organizations, as well as individual donors with checkbook giving. In fact, UNICEF, I think, has one of the oldest recoverable grant structures. They have reached out directly to their donors for checkbook giving during periods of low levels of cash flow. So all three, it's not an either or. That's the beauty of it.
I'll tell you what, we've got so many questions coming in. I'm going to get through our agenda, but this is really good. It shows a lot of interest. You're asking very excellent questions. What is the typical timeline that you're saying? Is it a year, 5 years?
Are you referring to the term of the recoverable grant? I'm assuming. Again, that is, there is no average timeline. It really is a function of what the purpose of the funds are being used for. I have had donors who have written recoverable grants for a short-term period of about 6 months, and the return of funds actually came within about 2 months. At Fidelity Charitable, we limit our grant terms and recoverable grants to 5 years. But if the donor wants to roll over, they have the option to do that. Again, there may be recoverable grants through intermediaries going to CDFIs for the purpose of constructing, say, affordable housing. That's a much longer term, investment, or investing in individuals who are going to pursue graduate degrees, and they're repaying the funds they're receiving as a longer term proposition.
Right. And another question is coming in. These are obviously very well educated people. They're probably CAPs, and they're asking, how does this differ from a program related investment that a foundation can do? And if I had memorized the answer pretty well from my CAP training, so I'll just say a program related investment from a foundation can't be with the intent of making money. It has to be almost by definition sub-market. The terms have to be such that the donor had no expectation of actually making money out of this. They might make 1 or 2%, but they're not going to make 5 or 10 or 15. Whereas it looks like a recoverable grant, there's no prohibition. You're not necessarily aiming to make money, but it's not kind of against them. It's not an expectation that you can't, right? You could set the terms in such a way that if the organization does extremely well, you could have a windfall too. Is that correct?
Yes.
Okay.
Yeah, and I just chime in. I think program-related investments and recoverable grants both fill a similar function, which is someone who's going to give funds with a charitable intent, with a potential to recover the principal of those funds and potentially more of that principal.
Right.
What we've seen, the primary difference is that program-related investments are investment securities. And so they will be an equity investment, a loan investment, or some other investment security. What they're allowing, the regulation around that is only for private foundations today.
Right.
And what they do is allow a private foundation to make a investment with a charitable intent, and in return to be exempt from certain concerns around jeopardizing investments, or for it to count towards their required annual charitable distribution.
Right.
And so what you've seen is program-related investments become quite popular among private foundations. Recoverable grants, on the other hand, as we noted, is a form of grant agreement, not an investment security. But some organizations may, receive both program-related investments and recoverable grant dollars. and pay them out in a similar way. So I think they are, we think of them as kind of two tools in the toolkit for philanthropists that both have some pros and cons, but allow even more flexibility for donors and philanthropic institutions to kind of make more change in the world with their corpus. I think that's probably the high-level message.
Right. That's very helpful. And Chris, you've got so many different ways, you think about these things because you're at the head of a company that's a vast endowment. You're head of a company that's got a foundation. You're a donor yourself. You're an impact investor yourself. You're a creative financing kind of guy. I mean, how do you think about this new tool, or I guess it's not a new tool, but new to me? How do you think about how
I think a lot of it, Phil, is just sort of the evolution of how I think philanthropists think about their capital now, and increasingly, they don't view it as two very distinct pools of capital, right? They have different intents, and so to me, this is taking an innovation from the for-profit world, whether it's venture capital or private equity investments, and bringing it to philanthropic dollars. And so I think a number of folks hit on the recyclable nature of this, the ability to do something much larger than you might do if you thought it was overwhelmingly permanent capital. And as you know, there are a lot of use cases where a lot of nonprofits today, they have a need for significant funds, but there's pretty good likelihood of programmatic revenue, that this is more working capital, if you will, or construction capital. I happen also to be a director in the YMCA of Greater New York. It's a classic example where, we've launched 2 new Ys in the Bronx. It's very capital intensive to build a state-of-the-art YMCA, but they will bring in revenue over time. And so I think the real key is, and I think both Adam and Susan hit it, are you okay if it doesn't pan out? You need to get comfortable in sizing the amount of your grant or your contribution. But this idea of getting leverage off of that, having an impact, and then recycling it to have further impact down the line is, I think, just an incredibly appealing concept for folks.
Kind of reuse your philanthropic dollars if it all works out.
And Phil, maybe the only other thing I would say is there's a lot going on right now where nonprofits are creating their own innovations and figuring out. And as you know, we're going through one at the American College right now with Purpose School of, should it be a for-profit inside of a nonprofit? Should it be a separate nonprofit? But it's sort of helping the nonprofit world monetize its intellectual capital to the benefit of the nonprofit itself.
Right. I had a question that came in about the risk to the nonprofit. In other words, a nonprofit takes this money as a recoverable grant. Do they have a legal liability to pay it back? Do they book it as a liability?
No, they do not. I can take that one. I get that question. I'm sure, Adam, you do as well. And probably, Chris, you have discussed that yourself, coming from the perspective of a nonprofit. As we've said, it is a grant. So consider that on the revenue side of the balance sheet, income statement, and it is coming in as something that is not expected to be repaid. And in fact, the terminology included in the recoverable grant agreement is such that it cannot be interpreted in any way, shape, or form as a liability on behalf of the nonprofit. And that is important, what Adam said with regard to the donor really needs to be comfortable. Chris said this too, with the organization. It has to be an organization first and foremost that you care about, or if it's in the case of an intermediary, you have to care about the purpose for which the funds are being put to use.
Yeah, if we shift the perspective a little bit, so now we're looking at the world through the eyes of a nonprofit. I mean, traditionally you think of a nonprofits as asking for money, receiving money. They also do earn money. They get government contracts, but how do you find the nonprofits react when a donor suggests, or when you suggest, instead of getting a gift, they're going to get this, recoverable grant with the implication they should pay it back? Maybe not the legal liability to have to pay it back, but this is an important donor and they're suggesting it. How do they react?
In my conversations with nonprofits, they love the idea for the most part because they view it as nimble capital. Many times organizations get faced with revenue constraints that were not planned, outside the budget, and they need to pursue a particular action, but don't have the capacity in the budget to do so. And having good relationships with donors and being able to offer this as a structure to donors, it's a win-win for both sides. I can give an example if you want briefly.
I think examples are always good. It helps to visualize what you're talking about.
Terrific. I had worked with a donor a couple of years ago whose family had been supporting an organization on the board as volunteers, as funders, and it was a human services organization that needed to expand it in its physical plant. And they had found out that the property next door to where they currently were located was for sale. And they had gotten a commitment from the state in which the organization is located to it basically loan the funds to the organization to purchase the property. But there happened to be a natural disaster that occurred right in the backyard of where the organization was located. And also COVID hit. And so, as we all know, there was significant impact in terms of revenue constraints on the part of municipalities and state governments. And so the state had to back away from the timing of their ability to fund the purchase. So they approached a donor, and the donor came to me and said, may I use my donor advice fund to basically make a recoverable grant and help them buy this property? It's going to be coming on the market, and it's now or never. It's a one-time shot. And that's exactly what happened. So the recoverable grant agreement is very simple in terms of the language, and even in length, it's about a page and a half. And for the most part, I mean, depending on how complex the donor and the grantee want to get, but generally it's about a page and a half. And within about a week's time, that organization had the funds they needed. They purchased the property next door. And then, this is actually the example I was referencing, that the term was for much longer than the actual repayment came in, because the state in a very short order turned around and gave the capital to the organization, which was then used to go back and repay the donor. The donor was happy. He helped out an organization he and his family cared deeply about. The organization was thrilled because they bought the property, and they're now constructing, a new building to expand capacity to help the community in which they serve.
Right.
And it's a win-win.
So it really was like bridge capital, right?
Exactly. Yeah.
Like Chris was saying. Do you have an example that comes to mind, Adam, of where you think this has really worked out well from the standpoint of both the donor and the nonprofit?
Yeah, I think what comes to mind from the nonprofits we work with is that fundraising is one of the most challenging things they do, one of the things that takes a lot of resources, and it's a big, slow machine involving a lot of people, calling a lot of donors. And as Susan said, what they look at recoverable grants to help them do is raise bigger checks from donors, raise it more quickly, and raise it for things that are hard to fund for traditional grants. One example, one of the earliest recoverable grants we worked on that many Fidelity donors participated in was work with Partners in Health, a large health nonprofit that tragically lost their founder in recent weeks. They wanted to build a state-of-the-art tuberculosis center very quickly. That was a multi-million-dollar build. And it was unique because over time, they expected that facility to generate revenue and profits back into the nonprofit that could pay back a donor. They didn't want to do a complicated loan. They don't have collateral. It's in a developing country. And through the recoverable grant, in a matter of months, they were able to get donors who might be typically writing $25,000 checks to write $100,000 or $250,000 checks, because they looked and said, every year I'm putting out this much in grants, but I have this other pot of capital that's just sitting in a fixed income fund. Maybe I can stretch into that to fund a nonprofit I already trust to do work that I'm comfortable some portion of capital is gonna go back and replenish my account. And I think that's what made them thrilled. And you kind of see that trend as more and more nonprofits do activities that ultimately is funding revenue, some form of revenue generation or repayment, because they're running a mortgage program or a lending program or a social enterprise, and they want to raise capital for those types of activities.
Right. Because
And Adam, sorry, Phil, I was just going to add to what Adam said and not affect their debt ratios, right? Because a lot of large nonprofits are obviously rated by rating agencies. This is equity or grant capital, not debt capital. And then I think the other piece, again, that's important is most nonprofits have so many good ideas But if you're the CEO of a nonprofit, you've got to focus on the biggest opportunities where you can have the biggest impact. So I also think a great societal benefit will be some kind of marginal programs that might be hugely impactful that now, as you said, Adam, are opening up a source of capital that maybe they didn't have before.
Where you kind of have an entrepreneurial person inside the organization who kind of thinks like a business person. And there's somebody like you, Chris, on the outside who is a friend of the organization, of the project. I think you can reach or meet the minds there more quickly sometimes because you're both taking an entrepreneurial perspective. We've got a lot of interesting questions here. So my understanding is these are typically done through donor advised funds. I mean, that's really where the focus of the panel is, but we're getting questions now about individuals. So let's say they have a client. Let's say the advisor has a client who's intrigued by this idea. And let's say they don't have a foundation. Okay. Could they think about making a recoverable grant from their own personal checkbook, or do they need to work through like a donor advised fund?
I would think of the donor advised fund as or a foundation, and your checkbook as being on par with each other. Those are the vehicles through which you are funding the organization. And the recoverable grant is the approach that you're using in your grant making. And so the answer is you do not have to have a donor advised fund. You do not have to have a private foundation. You have to have the relationship and the ability to explain it to the organization you want to fund if they don't know how to do it.
Do you actually do them for Fidelity clients? Do you find yourself actually structuring these for Fidelity clients except through the donor advised fund, or do you actually work with their private clients?
We have not done any direct structuring of recoverable grants that I am aware of, at least on the Fidelity Charitable side, for Fidelity investments, clients within private wealth or personal investing or otherwise. Not to say that that has not been done, but I'm not aware.
Right. Have you seen it done, Adam, through CapShift? Does CapShift facilitate these transactions with private people giving to philanthropy without going through an intermediary structure?
To date, we've just worked with a number of large staff providers and private foundations. I think in general, in some sense, that's why donor advised funds were set up, is to outsource the hassle.
Right. That was my impression too, because they're asking drill down questions. So let's say this person does write a check to the charity and this structure, they use the same paperwork kind of to say, if you're going to pay me back, please do. What's the tax treatment of that? Is that a question that we just don't know the answer to, or do we know the answer to it?
No, well, first of all, the checkbook writing is something related to an entity that is already you're using the assets from a nonprofit perspective.
Right.
So there's no tax implications of the assets.
Right. For the donor advised fund, what the donor advised fund I would like is the clarity. You've already gotten your deduction, and now it's pretty clear you can make a recoverable grant from the donor advised fund. But let's say you want to skip the donor advised fund and go direct to the charity with your own private checkbook.
It has to flow through a nonprofit intermediary. In terms of return. So there's no tax implications there.
I think that feels, I'm not an expert, that sort of feels to me like the clear way to do this is to do the known science of the donor advised fund rather than try to jury rig something on your own outside. Would you all agree with that? Because if you make a gift that's not really a gift, do I take a deduction? When do I take a deduction?
Right. Well, there is an issue, the IRS does keep a lookout for something called, private benefit or personal or donor control. And so that's where the intermediary comes in. The donor has basically released control over the assets going to the nonprofit. So there's an intermediary that is there.
Okay.
So you're one step removed as a personal.
No, thank you. So we're going to go through an intermediary. It's going to be the donor advised fund or the foundation. Is there a cost to these transactions other than what we've talked about that it may not get repaid? Is there a fee that's paid specifically for the intermediary, like for CapShift or for Fidelity to be in the middle of this?
It depends on who is working with the donor to structure it. As Adam mentioned, we have Fidelity charitable donors who have worked with CapShift for both impact investing, more investing approaches, and have become familiar with recoverable grants, and so have worked with CapShift, which is a platform and has a different structure. And Adam can go into that. At Fidelity Charitable, we do all recoverable grants for no fee.
Okay.
Yeah, and it's been great to partner with Fidelity at CapShift. We're an open platform, so we can partner with philanthropic advisors, financial advisors, DAF providers, or foundations. And our service goes a little bit beyond the administrative service, where what we've tried to do is go out and source and vet a few dozen recoverable grants from leading nonprofits and be able to bring them through a technology platform that helps donors and advisors understand what are these funds being used for and kind of the overview behind them, and then some deeper kind of ongoing monitoring around the recovery of those funds. This is still kind of new in the scheme of philanthropy. This, I think, lends itself to donors who want to be innovative, who want to do more with their capital. This isn't, though, for $500, you're not going to do a recoverable grant. We tend to see it maybe around, Susan can correct me, but maybe $10,000 on the lowest end and up to $1 million plus on the high end. And I think it's, you know, folks at that range saying, I want to be more intentional around not just writing a grant, but almost kind of helping transform the nonprofit, right? And do something that's long-term and permanent with my philanthropic capital by kind of creating a new program or building something that's going to last.
Right. This self-sustaining, basically, it feels like you're jump-starting something you hope will be self-sustaining on the part of the charity from its own internal operations.
Right.
What is the business model, since they're asking for CapShift? In other words, kind of going back to who's making money doing this?
Yeah, we charge a one-time, administrative fee to support recoverable grants through that end-to-end platform. I think what we've aimed to do is just make this more easily and more accessible.
I think we've got a lot of people who are very interested in this because they're asking very specific action-oriented questions. Where can we turn for industry standard language to document this? You've done a lot of work. How would they get it if they wanted it? How could they, if they were not working with Fidelity, if they were working with some other donor advised fund?
Yeah, I can't speak for everyone, but I do know that the recoverable grant agreement that Fidelity Charitable uses has been shared with other national donor advised fund sponsors. And I believe it's also being used as a basis for some large community foundations who are also doing more recoverable grants for their community oriented donors. And it's something that Adam says the same thing. We want to grow the sector, and it isn't for everyone, but it is a really interesting, innovative approach. And so we want to make whatever documents we can available in order to grow the sector, which lifts the nonprofit sector up, which is all of our objectives.
Actually, if that had not been the answer, we would not be doing this webinar on these terms. We're not actually trying to promote CapShift or Fidelity. We're really trying to uplift. And I think that what's really nice is that both of you are really field builders. You have particular business models, but the intention is to build the field.
And I just add to that, Phil, which is I think people may be surprised about how many leading nonprofits now offer recoverable grants and how many issues you can make change on. So, ones that we've worked with include, UNICEF USA, Habitat for Humanity, Kiva, water.org, whether it's climate, poverty, education, health, there's really opportunities across the spectrum. And I think that's what's kind of caught the eye of philanthropic and financial advisors saying, oh, this can be more of a broader tool to bring to my client base.
Right. So this is a question I'm going to ask Chris, even though it's not, I think you'd probably want to reframe it, because what the person is asking is, from a donor's perspective, what are the, let's say you're doing this through a donor advised fund, because I think we're trying to say that you're not going to go direct, but what are the tax advantages they're asking for the donor? And I think you almost have to say, there's no specific tax advantage, right? Because you've already given your money to the donor advised fund, but what would be the benefit you would see as a donor?
Yeah, I would say I agree with you on the tax perspective. It's a grant like any other grant, whether you do it through donor advised fund or some other vehicle. I think the benefit is this idea of recycling your philanthropic capital and getting leverage on that. So it's just an ability to open up what I might consider in some cases venture capital, or as you said, bridge financing, but applied to the world of nonprofits. So I think this is in the long run a game changer for the nonprofits who have programs, infant programs they want to fund. Maybe they can expand a bit faster. We've given a few of those. So I think it's, again, taking an innovation for the for-profit world and saying, well, why can't I do the same thing in my donor advised fund or my private foundation? And so I think that's the appeal, is that this is capital that's going to generate a return, which means it's going to have an even greater capital when I recycle it down the road.
You can do more good because you can reuse the money to jumpstart more than one project.
Yeah.
You
Even
know?
if you just said working capital for a nonprofit, they have tremendous needs for working capital, but it's not always easy to get.
Yeah. And I keep thinking too, from a nonprofit standpoint, there are people in nonprofits who are entrepreneurial by nature. I mean, they may be temporarily working or permanently working for a nonprofit, but they think in terms of sustainable models for what they're doing. They look for an opportunity to get revenue associated, like tuition or patients or, rental, whatever it is that is going to allow the nonprofit dollars to get recycled to keep the program going once the donors kind of fall away. And it feels to me like that kind of a person at a nonprofit would be greatly encouraged by this if they could pair up with a donor like you to kind of co-conspire to create a really great program that might require some upfront funding, but would then be profitable or cash flow positive later.
Well, if you think about it, right, if you ran a for-profit company, and we all have these, where you have initiatives that may not be core to your
Right.
business, but they're great ideas and they're
Right.
ones that really can have an impact. Well, that's what you would do. You would approach potentially a venture capital, so you'd spin it out. Well, why in the world can't a nonprofit do that? I mean, there's no, there's no moratorium on creativity
Yeah.
that can come out of the nonprofit sector.
Yeah. So here's a question, I think, from the nonprofit perspective, probably I have to assume this is from a nonprofit fundraiser. And this may be a question none of us have encountered before, but let's see if we can wrap our minds around it. If the nonprofit organization is in the middle of a capital campaign, okay, and they have donors that kind of hit this profile of being entrepreneurial, how would the recoverable grant be booked for the credit towards those goals? So, if you give $100,000, you end up on a certain wall and so forth. In the campaign, people get credit for having raised the money. So if they raise the money, how would they count this towards campaign total? So have you ever come across that question? It's probably a question the nonprofits solve for itself, would be my guess. They've probably got to figure that out for themselves. I don't think there's probably a legal answer, but have you ever run across that?
Right. Well, I can speak to that from the perspective of having been at Duke University during its last capital campaign, and certainly booking gift credit is very hotly debated. And so from a gift crediting perspective, you can think about it similarly to your intention or a multi-year pledge, if it's from an some pocket of money that can make pledges. If a donor commits to a nonprofit pledge or makes a multi-year intention, they may make, and say they make, a $500,000 pledge, but in the first year of their agreement,
Right.
they're funding 100,000. Well, how does the nonprofit organization book that pledge? Do they book it all up front? Or do they, from an accounting perspective, just book the funds as they come in?
Right.
I know there's a difference between the accounting treatment of the gifts from the use of the complete intention for furthering fundraising purposes. Right. And I don't know that there is much experience from, at least from Fidelity Charitable's perspective, of donors using this in the context of a capital campaign. I'm not sure there has been an alignment of opportunities there yet, but it will be interesting to see what happens. That's a great question. Thank you.
Yeah, that's a good question. So here's another one. These are interesting questions. I mean, obviously people are processing this against their own opportunities to use it. So it's a grant, not a loan. And the repayment is to some degree optional. In other words, the donor can't extract the payment from the charity. By what authority does the organization decide they're going to exercise their option to repay as opposed to just keep the money? In other words, does that put somebody in a bind inside the organization to say, well, let's give them back the money because we're doing so well with what they gave it towards? is that like an act of kindness? And how does the CPA or the comptroller deal with that? Because they're supposed to be receiving gifts, not giving them back, so to speak.
Right. I will say from a donor's perspective and the relationship with the organization, you look to the terms of the Recoverable Grant Agreement itself, because it will, in some way, shape, or form, reflect a source of repayment that may or may not happen. If you think about participating in a situation where there is construction, let's say you're working through an intermediary to fund a CDFI for the construction of affordable housing. You are funding the construction, you're providing construction funds. The repayment will come when that project is completed. There's a revenue stream to show a more traditional mortgage lender who will then write a mortgage on the apartment building, multifamily housing, and that's the source of funds. So although it may sound, in the way we've been approaching this conversation, as somewhat arbitrary on behalf of the nonprofit, it really isn't that arbitrary, because I think, as Adam mentioned, that there are so many different purposes, and generally speaking, a donor goes in knowing what the sources of repayment may be, but that does not mean that source always comes through to provide the repayment. And you also have to keep in mind that, as we all know, this is a relationship business between a nonprofit organization and a donor. And I don't think anybody, would suggest that a nonprofit organization is going to not repay a donor when source of funds have come in. That could wreck a pretty good relationship.
Oh, these are interesting questions.
Yeah, Phil, I just add a number of the questions are quite technical, so I did throw in an email in the chat if there's any that aren't answered. May not be appropriate for the webinar.
Well, I think that's right. I think we get pretty close here to giving accounting advice, legal advice. So for that, we're not trying to do that. We're just trying to explore the issue and see if there's a point blank answer. And if there probably isn't in many of these cases, because this is a new thing, they should get in touch with you individually and consult their own legal opinions. We're not giving them definitive advice here about how to handle the accounting for recoverable grants and all of that.
That's the right disclaimer. I would note, though, that beyond recoverable grants, there are many complex grant agreements that have a provision to recover the grant if the nonprofit doesn't follow the side letter stipulated in that grant agreement. Many nonprofits also re-grant funds to other nonprofits. So there's kind of lots of examples of nonprofits that are granting or re-granting funds to other charitable entities. And so this isn't something so novel on that behalf.
Again, we want to slide this under the same disclaimer, but how does the recoverable grant differ from a forgivable loan?
The biggest differentiator is it's not a loan.
Right.
I also guess tax implication, correct? One is a grant, you're getting a deduction up front. I wouldn't suspect you get a deduction for a loan to a nonprofit, but
right. So we're
violating our disclaimer right now.
We're going to definitely sweep everything here under a disclaimer. Because
and I would just add, a number of the questions are related to kind of an individual donor making a recoverable grant. Again,
right. I think we really have got. It feels to me like this is really about recoverable grants inside a donor advised fund is what we have expertise in.
Or private foundations, and I think from that standpoint, it can contribute to payout of a private foundation, just like any grant distribution. And then when it's recovered, because it's going to another charitable vehicle, you don't see tax implications or things of that nature coming up. And so because it takes away a lot of those concerns, that's why these vehicles have become quite popular for making recoverable.
As you think about this all in all, and you're thinking about the audience, which consists of both advisors and nonprofit gift planners, okay, what do you see as being their opportunity in using what they've learned? Where do you, if you were kind of trying to get them on the right track to explore with the right people for the right purpose, what would be kind of your advice if you could reframe their attention so they're really looking at the opportunity and not all the technicalities?
I'll jump in and it'll reiterate the message of, there are a lot of things in philanthropy, charitable remainder trust, donor advised fund, recoverable grants that in some sense are somewhat technical in nature and involve your ordinary donor isn't going to want to understand those details. So typically when we talk about recoverable grants, we don't even focused on the word itself. It's more around, are you trying to help a donor be more catalytic with their philanthropy, help them write a bigger check to a nonprofit while protecting the long-term giving power of their charitable purpose, or helping nonprofits be more financially sustainable, take big bets. And I think this is the kind of language that makes it advisors develop more sticky relationships with their clients and saying, we're going to be value add by going beyond kind of just the traditional grant making and giving you more tools in your toolkit to make the change in these massive problems, we're all trying to tackle with limited funds.
Phil,
and I would throw in, sorry, before, one thing I forgot was there are kind of a set of existing recoverable grant options, but we see lots of donors creating custom recoverable grants. And it's both ways. There's some clients who are saying, I want to make more change, show me options. And others say, no, I know the nonprofit I want to support. As Susan said, can you help me, be creative with how I can support them with a bigger check?
Now, Susan, if you were talking to somebody who is, a significant holder of a donor advised fund with Fidelity, and you're going to broach this topic, how do you even get into it? In other words, what is the preamble or the conversation that leads up to it? How do you know you have somebody who needs to hear this, and how do you frame it to them?
Usually the cues for me in conversations with donors is if they bring up any term that is closely related to impact investing, or even just using the word impact. Donors may say, when they've opened up their account at Fidelity Charitable, and I'm getting them familiar with not just how to use their account, but trying to help them become more effective with their grant making. In the questions that I ask, trying to flush out, what is it you're interested in? And if the answers, have something to do with impact, then, you ask a few more questions to sort of peel back the onion, and you find that, they may have had a private foundation or still have a private foundation, and they are used to program related investments. I may have looked at their 990 before I met with them to find out, what were they doing with their grant making? And so any cues that they give you is an opportunity to ask about it. They also may say, the donor advised fund is a great flexible opportunity for me to do something different than just write checks out of my checkbook. I'm really looking forward to, becoming more of a collaborative grant maker, or, which is what Adam is referring to in terms of funding alongside others, like CapShift worked with Partners in Health to do that and bring together this great collaboration of donors. And they may say, how can I work with other donors? And, that's an opportunity to talk about some third-party intermediary opportunities to fund, career-related support, for example.
Well, let's say you identify the profile there. They're somewhat, would it typically be somebody who's got kind of an entrepreneurial background, or is it very often women, or is it younger people? I mean,
we recently did a survey of Fidelity Charitable donors, now not just those in our private donor group, but across the entire spectrum of all Fidelity Charitable donors, because we have now about $3 billion in assets under management that are impact related assets. And so we wanted to, again, dig around and see what is the profile of our donors who are investing in this way. Yes, it is very true that a great number of them skew younger. Millennials, Gen Xers even, some boomers. I will say that's not to the exclusion of boomers. Women tend to be very interested in the topic of impact investing and the recoverable grant. They may have been more likely to participate in a giving circle, if you will, and through a community of learning with other donors, it may have come up. But I will also say, and Adam, I'd be curious to see what your perspective is on this too, because you do work with other donor advised fund sponsors besides Fidelity Charitable, is that it really isn't specific to any demographic. I think writ large, the topic of impact investing is something that is an attractive hook for millennials and Gen Zs, but people, when they learn about it, forget about putting a label. When they learn about it and the recyclable opportunity, the providing of the catalytic capital, like
Right.
that's exciting. That's no longer your great grandmother's
Right.
philanthropy, right?
Yeah.
Yeah, and would echo Susan. We have former entrepreneurs, we have old, we have young. I think there shouldn't be a stereotype, but as Susan noted, the words we would use is this is someone who wants to be more active, someone who wants to be more engaged, someone who wants to do more. And thus, I think advisors, these tend to be the clients who are pushing them and saying, help me do more, versus someone who's just doing a more traditional grant making to local organizations, very happy, may not be as interested in this.
Right. I guess somebody else is asking, I'm wondering too, who initiates these conversations? Are people coming to you and saying, I've heard about recoverable grants, help me to do it? Or is it more starting with a feeling the client out about what they're trying to accomplish and then seeing a fit and then suggesting it? Or is it coming from nonprofits who've experienced a successful one and are now soliciting their donors to do more?
Chris, how did you first hear about recoverable grants? From you are both a donor and you are both sides, but as a donor, how did you first hear about it?
Yeah, I mean, obviously long history with donor advised funds, and I have made some investments in what you might consider B Corps, Giving Capital itself going back 20 years. I don't think the term B Corp existed. And so it was just sort of a natural evolution. It was another investor in CapShift who sort of opened my eyes to you can use entrepreneurial techniques and entrepreneurial financing techniques, and you don't have to therefore turn something into a for-profit that perhaps should be a nonprofit activity. So that's sort of the extension in my mind, and so obvious when I heard it, but a little bit like, I think Adam, you made the comment of most people don't know about this. I would have said the same thing 20, 25 years ago about DAFs. Very few people knew what donor advised funds were, and that was part of our mission at Giving Capital, to run around and beat the drum. And admittedly, we were probably a decade early. But I think most
donor
people
advised funds have been around since the 1930s. So
yeah,
not
exactly.
like they haven't been around.
So again, I think this was the next evolution. It's almost like, in my mind, there's a grid or a matrix of what kind of capital is it? What are you trying to accomplish? And are you trying to do it with your for-profit capital, your not-for-profit capital, your philanthropic capital? And that, I think, sort of helps where this fits, which in some ways it's either B Corp like or working capital, or building a new hospital was an example given, or a new YMCA, and not forcing you to choose what pot of money you want to use for that.
From your position as the head of an insurance company, you've got a foundation, right? You've got a corporate foundation.
We
Do
do.
you see any fit between the corporate foundation and the nonprofits that you normally support? Could there be a way to leverage that capital?
Yeah, I think so. Part of what's happening right now is you think about trying to engage employees, and people talk about the great resignation. I mean, we've been quite fortunate. Our voluntary turnover is quite low, but part of that is it's all integrated together. Employees volunteering in the local community, executives pooling dollars for a certain cause, and now having a corporate foundation that can focus on certain activities. So it's really all part of the same thing. What employees are screaming for is engagement. I want to believe in the mission of whoever I work for, whether it's for-profit or not for profit, and I want to be able to roll up my sleeves and get engaged. And so to me, these are all tools that are part of building your brand as a company in your local community. And look, there's times the pandemic brought out a lot of these opportunities. We leaned heavily into food banks because the hue and cry and the human need was so just outrageous, right, that there's times when these should be just pure outright grants. But at the same time, you get approached on other opportunities where you say that could be something that is a 20-fold impact, but it requires a different type of capital.
Yeah, thank you for saying that. There's a question coming in. I think you're really responding to it in a good way. The person is asking if a religious organization is doing mission work, let's say, in foreign mission fields, and they're relieving poverty and relieving suffering, but there's no revenue associated with it. This is really helping those who will never be able to pay it back because they're hungry. Would that fit for this kind of a situation? I guess I would say no. I mean, if you have a pot of money that you can just plain give as a donor, that's the kind of place you might give. Would other people agree with that? That these are worthy causes and they would call on a donor's heart and soul to give, but they would not be a good recoverable grant opportunity unless you can associate some kind of financial return with it.
Yeah, the only way I might connect the two, be curious what Susan and Adam have to say though, is, but conversely, if someone says, hey, I want to start such a program, right? And I need startup capital, it could be returned depending on the types of funds that we're able to generate, or if we get any programmatic revenue from government agencies or anything of that nature. But yeah, I would say if there's great need and suffering in a community and we need to, for X period of time, resolve it, yeah, that doesn't feel like a classic recoverable grant.
Yeah, I think we're running out of time, but it's very fascinating. It reminds me of a statement that Tracy Gary made, that early money is like yeast, it makes the dough rise. And even in a program that's driven by fundraising, that you do need some early money, even to have a fundraising program to raise money, you need somebody to bankroll the beginning, and maybe there could be bridge capital for that. But this has really been fascinating. I think we're running out of time, but I do want to say that if you're interested in more, this is not a locked-in situation. Everybody on the panel is kind of has an open source mentality, and some of you are asking about, can you get help from Fidelity? If you don't work for Fidelity, don't have a Fidelity donor. I think Susan would say, yes, she'd be willing to share her documents. Is that correct, Susan?
We'd be glad to help.
Yep. In CapShift, you work with a wide variety of intermediaries, right, Adam? So it's not like there's a lock-in if somebody wanted to get in touch with you about how they could use you in some new way.
Yeah, about half of the major DAF providers are now supporting recoverable grants in some way, and we partner with a number of them. So anyone's welcome to reach out to us, and we're happy to share more.
Fantastic. Well, I've really, every time we do this, I've now been on various conversations with you, probably 3 hours each, and I've learned more each time I do it. So thank you very much for participating.
Well, and thank you all for participating and the great questions. And I enjoyed the conversation. I always learn something as well. So it's great to have been included in this. Thank you for the opportunity, Phil.
Thank you, Susan.
Likewise.
And thank you, Chris, and thank you, Adam. It's always a pleasure to be with you all.